Welcome back to the What You More podcast. I'm your host, Quinton Harris. You're dialed in for episode 221. And, before I get into my segment today, I kind of wanted to say, you meet these people that kind of come through your life and help you out. And I lost a good one this last week, Mr. Bill Flemister. You know who you are, an appraiser that's done a lot in our world, helped us out for many years. And for those that are listening, that got a chance to work with him and had the pleasure to meet him. He was a great dude. And oftentimes, he and I both talked about our time together at the Tennessee Vols and a lot of the football games and how we commonly joked living here in Florida. We were in football hell for many years. But Bill, you will be missed, and it was great getting to work with you, and better yet, having you as a friend. So let's move on to the episode here. So one of the things I wanted to get into was that, we take a minute to read the comments you guys put out here. And the last episode I did on credit card debt versus applications, limitations, credit limit increases, we got a little bit of feedback on there. And I want you guys to know that we read that. More importantly, I kind of want to take a minute to kind of answer some of the questions and some of the debate that was on there. Because, for me to go in there and read everything you guys put on there, obviously this is not my full-time job. And there was a lot of comments. And some of them were rather lengthy. The shorter ones are easier to kind of respond to. But I did want to take some time to kind of go through just a couple of those here to kick off the show. And, one of those things that I wanted to respond to was the ideology that, that I was pigeonholing a certain group of people in credit card debt and how credit card debt was going to crash the housing market. By no means, that's not what I was saying. I want to be ultimately clear with that. And back up there. Let me start with the group that was online saying, hey, listen, the bulk of this credit card debt is coming from people that are non-homeowners. They're renters. They're in their 20s. I wasn't going to get into an argument with that, but it's actually not true. And the reason for that is that you can actually find data sets that point to there's more credit card debt per homeowners than there are for renters. And I kind of go back to my days when I first got in this business. I was doing credit cards along with mortgages. Like, imagine that. Think about this. It was the job that I had where during the time you would work at the same company, but that same person would do credit card lending, you would do auto lending, do mortgage lending. I mean, you kind of did it was all one-stop shop operation. You don't see that anymore. You don't walk into a bank, sit down with a personal banker, and they do all that for you. They'll facilitate it. They'll pass off to someone else. But at that time, when I graduated, that was a position that I held, and I did that for all facets of lending. Learned a lot during that time. I wouldn't take that back, but it taught me a lot. And one of the things it taught me was that one of the questions you ask on applications, no matter what type of credit application it was, is, hey, listen, are you a homeowner or are you a renter? And you're even asked that today. When you go buy a car, they ask you, do you own your home or do you rent? When you get a credit card, they ask you, do you own your home or rent? Ultimately, when you get a mortgage, they definitely ask that question. But there's a reason for that. It's not just on their happenstance, take up a line on the paper. It's there because it's an evaluation. And if you're a homeowner, you're probably going to get a higher credit limit than if you are a not homeowner. You're probably going to get more credit obligations if a homeowner than you aren't as a homeowner. And so that's kind of one of the things that I kind of have experienced here and kind of wanted to point out, and I couldn't really get into that in those comments. The other thing is that the national data suggests that the homeowners actually have 3 times more credit card debt than non-homeowners. And we all know the first-time home buyer is now 38 years old. But if you back it up to when it was 31, 32, 33, go back just 3, 4, 5 years ago, those are people that also are encumbering credit card debt. And we've talked about this a little bit from the segment of that lock-in effect. And, I was going into this of why I don't think, when I'm talking about consumer credit storm brewing, what's happening is I'm talking about a default rate on credit cards and people just saying, I'm out. That's not going to really take down the housing market. What that's going to do is that's going to cause people to have some sort of repercussion in their credit score, which could impact them actually refinancing or impact them actually buying another home. That would slow down and curb the demand of certain people. What I was suggesting was that this could actually unlock the lock-in effect. That's where I was going with it on that conversation, because if people accumulate so much debt as a homeowner, there's a level of responsibility from that homeowner not to just walk away from it. They'll actually say, well, maybe I can just pay that off and consolidate my mortgage. And I got to put a graph here on our YouTube channel. Our YouTube channel is at What's Your One More with the number 1. But I've continued to say that, hey, listen, this lock-in effect is a real thing. And we know that 90% of all loans for a while were under 5%. Now we're seeing that number start to come down. And in this graph, what you'll see, and this is courtesy of BCA research that we got from John Malden Economics, one of the things you'll see here in this graph, I'm going to draw this little red line on here. And what you're finding is that the black line represents 3% mortgages in the United States. So there's essentially saying, hey, listen, about 38% right here of mortgages in the United States had a 3% handle on them. And then this green line is showing greater than 6%. And notice in 2022, obviously when those rates jumped, there has been a significant rise. We're almost getting to 20% of the mortgages in the United States have a higher than a 6% interest. But what we're finding is the gap between these two is getting closer and closer. And so I'm showing you on here over the course of the last really 16 months, this significant downward trend on these 3% mortgages, meaning people are refinancing. You could argue maybe they're selling, but they're probably refinancing. And that's where I was going with that, is this credit card debt is playing a little bit of a role in that and accelerating these unlocking of these mortgages here. And we're seeing it right here from this data from the Federal Housing Finance Administration on their national mortgage database. So we're going to continue to watch that trend, but it's already starting to unlock. The question is, will the door kick open and those transactions continue? We'll see. I think it's going to take a little bit of a lower rate. And as we get towards the tail end of this year, we do our 2025 forecast. We'll talk about that and more at that time. So we're going to take a quick break. I'll be back. I got more to cover on the second half of this episode, so we'll be right back. If some of the stuff we're talking about on the podcast interests you and you're like, hey, Q, I want to be a homeowner. I want to buy an investment property. I want strategies on how I can take advantage of the market. I have a solution for you. And that solution is Loan People, to where it's all about the people getting the loan and the people doing the loan. You guys know me by now. I've been doing this podcast for years, but I've been in the mortgage business for 23. And it's very rare you can find a company that has a mantra for loan officers, by loan officers. And what does that mean? That means you have a company that's designed to help provide the best atmosphere for loan officers possibly imagined. And not only that, the most efficient operations for those loan officers to be successful, which provides a better customer service. And that's what you get at Loan People. So much so that they put that in the company name. And at the heart of this is the people. It's in-house processing, it's underwriting, it's closing and funding. And why choose them? They got great rates. They close on time and they have award-winning service. So check them out at loanpeoplejax.com. That's loanpeoplejax.com. So welcome back. You know, one of the things I was talking about pre-show with my producer in that previous graph there, if you're looking at our YouTube channel, I want to point out, it doesn't necessarily mean those 3% mortgages are trading for a 6% mortgage. What it means is that if I have a 3.5% mortgage and I'm like, oh man, I'm either going to sell it and go move somewhere, or I'm going to refinance it and consolidate debt or take cash out or use the cash to buy something else, right? We talked about that in the last episode. All that means is that a significant amount of the mortgages in the United States that had a 3% mortgage have now gotten out of that 3% through one of two transactions, either selling the property or turning around and refinancing it. And that green line means that new purchases are happening, or they're refinancing, or those could be refinances in those higher rates, right? It could be some of that, but the reality is probably new purchases taking place. So I just wanted to clarify that. I thought it was a good question brought up there. So we had job reports week, right? We've been talking about the job report week, what's going on, what it means. Well, we all know this. The Federal Reserve, this is their new hot button. Inflation, I mean, they're not really talking about it as much. Target range, we all know is 2%. But this week, we get ADP report. And Friday, which is going to be tomorrow, we'll get the BLS report. And I'll do a whole segment on that. But I kind of wanted to bring up the ADP report because I think the audience knows how I feel about the BLS report. I often refer to it as the BS report. But ADP is the private sector, and it has kind of been a little bit more, how can I say it, of a guiding light, if you may. It's been a little bit more accurate. And I got to go through like what we got on Wednesday because there was a significant downward revision. Last month, they beat expectations, right? It came in higher than expected, which kind of drove the market into a downward situation, meaning that it didn't help bond market and it really didn't help the mortgage-backed securities market. It actually impacted it, but then we got the revision this month where it was off by 49,000 jobs, meaning they're saying, hey, the market created 233,000 private sector jobs, but when we really went back and looked at it after all was said and done, it really was only 184,000. That's a pretty big miss. That's almost a 50,000 miss. And again, we talk about that the markets react on the first wave of the numbers, not the revised number. And the challenge I find with that is you would think at some point in time the markets would get it right. They would say, we're not going to continue to just react. We'll wait and digest these numbers. But, there's no reaction to the revision. There's only a reaction to the initial numbers that come in, and we sit back and yet again, another big miss. And it wasn't even close. And, inside of that 49,000, that was missed is 26,000 manufacturing jobs. Now, I talked about this on the podcast too as well, is that the production of goods, right? The manufacturing of goods, that's the leading side of the economy. That's the engine of the economic, or I guess that's the leading part of the economic engine, if you may. The consumption of goods is the caboose. We talked about that, right? That's exactly what's going on here. So when we're losing manufacturing jobs, That means we're not producing as much. And that is going to continue to show up to be an issue. And I know that when we look at the manufacturing indexes that come out, they're all below, getting very close to that 50 number. That's a big deal. And so I can't not talk about that. I can't sit back and not go, man, this is a big deal. And, and the other thing is this. So then we got the first wave of the ADP job reports on Wednesday. Now, I'm not talking about the revised ones from October. I'm talking about the ones for this month now. And they came in and missed again. I mean, they were slightly below what they should have been, expecting 165, came in at 149. And the question is, what is the revision going to be for next month? Is it going to be even lower than 149? I use this analogy all the time, but if you're a first-time listener to this, do me a favor. Go to our YouTube channel at What's Your One More with the number 1. You can also check us out at any of our social channels at What's Your One More with the number 1, where we put our reels and you get all the hits and all that stuff on there. But if you're listening to this episode, you're in your car, you're going for a walk, walking the dog. A lot of our listeners do. They walk the dog when they listen to this. I get feedback from that all the time. But if you're listening, go to our YouTube channel, look at the graphs, look what we're putting on there. But what you'll find out on this is the analogy I wanted to get to is that imagine your child, or imagine you talking to your parents. You take an exam in school and the teacher goes, hey, Q, you got an A. And I'm like, man, hell yeah. And so for a month, I'm going home. I'm talking to my parents for a month. Maybe I'm putting something online. I'm going around. I'm telling people like, hey, what'd you get on the test? I got an A. Oh man, how'd you do it? I studied. Yeah, I crushed it. Right. And you're going around and next week you got the A. You're still feeling good about yourself. And then a month from there, you go back to that class. The teacher goes, psst, hey, I made a revision. I messed up. You really got a D. It's like, what the hell? I got a D. I just told everybody I got an A, and now I got a D. So here I come again, walking down the street, walking down the halls, whatever. Someone's like, hey, Q, man, how'd you crush that test? Oh, you mean the one I got a D on? Yeah, that one. What happened? Oh, man, teacher revised it. What? That's like the reversal of a curve. Could you imagine that? And that's exactly what's going on with these job reports here. And it's in a larger magnitude than what I'm describing because it affects the whole economy. And so I think that's something that is very irritating. And unfortunately, the market reacts to the headline, not to the revision. And you would think by now, after 26 months of dealing with this nonsense, we would get it right. And we haven't. And when we continue to look at jobs, I talk about job claims being the leader, jobless claims reports being the leader. We were up to 224,000 jobless claims, and continuing claims fell to 1.87. The continuing claims falling on a positive side of things. The jobless claims being up, you could argue as a seasonal thing here, but it's up. And until it gets to about 275, we're not going to catch any type of attention of the Federal Reserve. But when that number hits 275, and remember, those come out every Thursday morning. When that hits 275, we're going to catch the attention of the Federal Reserve and that committee, and they're going to say, well, something's not right here. One of the other things we got this week, and again, tomorrow's the big BLS report, is going to be the Challenger report, the Challenger job cut report. Now, what was interesting is it showed us that job cuts, meaning employers cutting jobs, was up 27%. So we're starting to see some things that aren't really making sense. We're creating jobs, but then we're revising them to a lower number. We have employers cutting jobs at 27%, up 27% from the previous reading from the previous reading from last year, which is a significant rise in comparison to what it was last month. And on the hiring side, it's slower to hire. So we're quicker to fire, slower to hire. And so that also goes with the JOLTS report that we were talking about as well. I guess where I'm going with all this is that the job market is constricting. It's not improving. Now, remember that. That's important because that's what the Federal Reserve has said. Well, we think we have a stubborn and a strengthened economy, that we're okay, and the job market is showing signs of resiliency. I think you're seeing signs of constriction here, and that's important because that is also going to lead the way for the Federal Reserve and their cuts and their decision-making down the road here. Because inside of this, you talked about job employers only announced that they're going to hire 761,000, roughly 760,000 year to date, which is down 2% from the same time last period. But it's one of the lowest amounts we've seen in 10 years. Think about that. One of the lowest amounts we've seen in 10 years because there was that COVID period in there that really got lows. And this is one of the lowest ones we've seen in 10 years. So it's interesting, and it does pose a question of, is the job market as strong or as stubborn or as resilient as the Federal Reserve says it is when they talk about it? I don't know. We'll find out that in the next coming days, especially tomorrow on that BLS report. Guys, if you like what you're hearing, please 5-star review this podcast. Share it. Listen to us on Apple, on Spotify. Love your feedback. As you can see, we do address it. We do addressing those comments, whether it's online or here in the studio. And then more importantly, go to our YouTube channel. Check us out at What's Your One More with the number 1. Again, on our YouTube channel at What's Your One More with the number 1. Guys, thanks for tuning in, and we'll see you at the next episode of What's Your One More.
Got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.